Okay, so good morning, everyone. Welcome to the Macro Snapshot. It is Friday, May the 30th, 2025. Recording this, as always, in the morning. Keep in mind that it is May the 30th, so it's the end of the month. So we could have some flows. And what a lot of analysts are predicting, and we've already started to see that yesterday, is potentially just a rebalancing. So because of stocks have had such a great rally, we might see a little bit of, incremental selling of stocks versus a rebalancing of buying the bonds, just to sort of keep, those portfolios, which are 60-40 mix. So we could see some continuing, sort of technical selling in the stocks today, and a little bit of support for the long end. But that will be an incremental kind of thing. So other things to be looking out for today, we do have some data coming up at 8:30. Both, first of all, in Canada, for people who look at Canada, kind of interesting here. We have the GDP. So just let's have a look at those numbers here. You can see that the quarterly annualized expected to actually to have fallen a little bit. So the survey is calling for 1.7 down from 2.6. And then on the month-over-month numbers, just the sort of the March update. So this is a little bit of sort of old data, so to speak, but it is expected to be slightly better compared to the previous month. So that's just going to be interesting to see what's happening in Canada. In terms of the US, probably the most important thing is going to be the PCE number here, which we're getting for the April period, of course, which includes the beginning of Trump's sort of imposition, universal imposition of tariffs. The market will really not want to see inflation sort of accelerating at all. So let's have a look at especially the month-over-month number, expected to have ticked up to 0.1 from a prior of 0. And then probably the most important number here is the core number, which is expected also to have ticked up by sort of 10 basis points. The market will not want to see that go too high, and especially because this is of course, as we all know, the key number for the Federal Reserve. So the headline number year over year at 2.2 and the core number at 2.5. On the other hand, if this number does come in slightly softer, 2.4, something like that, 2.3, that would be a pretty interesting sign in terms of maybe, how things starting to turn, some deflationary pressures, a bit of a slowdown in economic activity. And we know this is super important because yesterday Powell had a meeting with Trump at the White House. And it was interesting just looking at the statement put out by the Fed, essentially emphasizing the fact that apparently Powell told Trump that he was going to be completely data dependent, and essentially trying to, and this would be not based on any political sort of interference. So Powell definitely trying to sort of assert the independence again of the Federal Reserve, and reiterating the fact that any future path of monetary policy would be data dependent. So this is some data today. Let's see what we get with the core PCE. Talking about data, we also had a little bit of sort of slightly softer data, potentially we could interpret it that way, yesterday. In the terms of the job market, and also it's kind of interesting to note that some of the sort of the job losses were in that sort of area around Washington. So we had Washington D.C., Maryland, and Virginia. So those states in the U.S. actually ticked up in the joblessness rate. So who knows? Maybe some of those earlier DOGE cuts, the Department of Government Efficiency, those cuts from February, March are starting to sort of to kick in. And it's interesting to note, while we're talking about continuing claims and whatnot, that a lot of the people from the federal government in the US who had been fired or took redundancy packages, they will not be eligible to put in an insurance claim, an employment insurance claim, basically for 8 weeks or so. And the point is that that period is now starting to begin. So what it means is that people who are fired, who may have been given 4 or 8 weeks pay as a kind of redundancy package, they now starting sort of in June and July will be able to put in sort of claims. So it could be that we start to see, initial jobless claims going up over the next few weeks' readings, and that will be interesting. And it does look as though things are starting to tick up slightly. So if you look here at this first chart, we've got the continuing claims, and you see all of these numbers are from previous years. Where the blue line, as you see, that's 2025. And you can see here, this is non-seasonally adjusted, that it is above 2021. So it is above a couple of levels here. So just starting to tick up a little bit. And if you look here at an average here, this is the 2025 versus an average of the previous years, excluding COVID. And you can start to see that at this time of the year, it is starting to tick up a little bit. So we're now getting in, above the 240, 250 kind of average. which is it's a little bit too early to say, oh, therefore the job market is collapsing or something. But there are some signs of weakness. And if we look here at the seasonally adjusted numbers here, you can also see here that the continuing jobless claims, we're getting pushing up towards that 2 million kind of mark, which it's not going down. Let's just put it that way. And what is interesting, I was listening to something yesterday from Mike Green, and essentially saying that with the rise of passive investment, remember that the stock market, especially the mega caps, they have a relentless bid every single week where people are obliged to put money into pension plans or 401k kind of accounts, and all of that money is just relentlessly pushed, especially into the large caps. But that's a function of people having jobs and those contributions coming out automatically every week. So what's going to be interesting is to not, from what Mike Green was saying, and as I say, it's quite a curious point, is to say that rather than looking at the current level of the stock market and say that that's reflecting sort of underlying strength in these companies, another way of looking at it is simply to say that in order to have all these massive passive flows into the index funds, you need a stable workforce. So if the workforce starts to actually slow any sort of decrease, then those passive sort of flows into the index funds will automatically will cease to exist, and that will put downward pressure on equity prices. So the point is here is that there is, if you're looking at the passive indexing sort of support for sort of the broader indexes, you can see that if the job market here starts to weaken, that ultimately will also start to weaken those inflows, which will weaken the prices of the stocks. So that was a bit of data we got yesterday. The second data we got yesterday was that if you look at the sort of the personal consumption or personal spending, you can see that you see here the contribution to GDP growth. This is a number we got yesterday. It was actually down quite a bit compared to the previous quarter. Of course, it's only in services spending. So we see here the goods spending didn't contribute at all. So people seem to be pulling back on spending on goods. They're still spending on services, but to a lesser degree than previously. So could it be that the consumer in the US, is starting to feel the pinch, is starting to feel a little bit under pressure? Maybe that's just sort of psychological concern about the tariffs or inflation or just general sort of lack of confidence in the economy. But if we do start to see those jobless numbers, jobless claims go up, that's also going to dent confidence as well. So interesting here. And the way to take that away is that if we actually just look at a couple of charts, we can see here that quite a few of the charts were reversed yesterday. So let's have a look at, let's say the stock. So if we look at something, where's my stock? So you can see here quite a lot of reversals here technically. And this is if you look here, you've got some kind of shooting star for those of you who like Japanese candlesticks here. So if you're looking at the ES mini, you can see here that at this sort of resistance level of about 59.95, couldn't quite make a new high. And we actually have a little bit of a reversal candle there, sort of a shooting star, which, for market technicians is a sign of potentially a topping formation. Similar kind of situation here in the NASDAQ, quite a strong one as well. We also see in some of the other sort of key markets here, for example, the dollar, you also see the dollar here had a big sort of reversal candle. And all of this, of course, is on the back of that news that the international or the US trade court would actually stop Trump's tariffs. But as the day went on, the market digested the fact that Trump would use other legal entities and other ways of putting tariffs on, maybe sort of, 150 days here and there. So the market definitely, any optimism was pretty short-lived. So we see the dollar pushing, falling down quite a lot, a reversal. And if we look at the bonds, getting back to the data as well, you can see the bonds actually initially fell on that news about the tariffs and the court decision. But then once we saw that data yesterday morning with the initial jobless claims and continuing claims going up and the personal spending going down, you can see that the bonds, the whole bond complex overall went up, and we saw quite a sharp reversal of sort of Fed funds pricing. So again, just looking at that, you can see how that was reversed yesterday on the back of that weaker data. We'll just go here back into the Bloomberg, and I will put up. So you can see yesterday we're at about 1.7 cuts for the end of the year. We're now up to 1.9 cuts. So again, about 20 basis points was sorry, about 10 basis points was sort of dovishly repriced. You see, it's really now getting to a point where we're very, very sensitive about tariff news, but also real economy data. The market is very, very interested to know whether this uncertainty and the tariffs and global trade slowdown potentially is actually having a real effect on the hard data. So, and yesterday definitely the market was pretty dovish reaction on that sort of softer data. Now, talking about sort of tariffs and whatnot. There's been some talk that the legal barriers might sort of slow down Trump's tariffs. So there's two things I just want to point out this morning. Is that number two? There's already talk that various members of the Trump team, the administration, they're going to use sort of different legal entities and statutes to be able to put on the tariffs. Some of those are only for 150 days, but the point is that Trump definitely seems to be determined to keep the tariff thing rolling. We had also news yesterday that Treasury Secretary Bessent said that talks had stalled with the Chinese, although he thought they would keep on, that they'd be taken up again over the next few weeks. And he did note kind of progress with the Europeans. But the point is, there's no easy solution here with the Europeans or with the Chinese. So there's a lot of uncertainty, if nothing less, and markets do not like uncertainty. And it's interesting that yesterday, even with the great NVIDIA earnings, that the Nasdaq couldn't maintain that level. The second thing, which is getting a lot of attention and is possibly quite important, is that buried within that sort of 1,000-page document, the sort of the big beautiful bill, which is all the spending and whatnot. There's a section 899. So section 899, which is getting a lot of attention. And this essentially, the sort of the formal name for it is the enforcement of remedies against unfair foreign taxes. So enforcement of remedies against unfair foreign taxes. So essentially, what the market is starting to realize, looking through all the details, is that this could be like a retaliatory sort of law against so-called discriminatory tax regimes from other countries. So think about things like, let's say in France, they're having like sort of a digital services taxes against, Amazon or companies like this. So digital services taxes. Secondly, this whole idea, this whole push for a global minimum corporate tax rate. Think of the Apples of the world and whatnot. So the Trump administration seems to be pushing back against these kind of measures by other countries and saying that they're a discriminatory tax regime. So what is it potentially proposing? It's proposing in Section 899 that individuals and companies, and maybe even sort of sovereign sort of entities like sovereign sovereign wealth funds, they could actually be taxed on sort of any passive income. So passive income, things like US Treasury yield income or sort of income from dividends. So this has enormous implications, because if you think about the incredible investment by foreigners in US assets over the last several decades. And I've just got a little chart here, which I've pulled up, which is, again, the Section 899 threatens taxes on foreign holdings of $31 trillion worth of US assets. So going back, let's say the last sort of decade and a half, you can just see how the money has poured into the US, in US assets. And so what this is basically saying is that any sort of, profit, so it could be passive income on like dividends, as I said, or even yields. So you imagine you've got a huge holdings of US treasuries, and if you and the tax rate being muted or mooted is something between maybe 5%, even going up to 20%. So if you think about it, I mean, I'm just being hypothetical here. If you have, let's say, a yield on the US 30-year paying, let's say, about 5%, and you have a 20% tax rate on that, that's essentially 100 basis points less yield that a foreign entity is getting, 100 basis points less. So does that mean that the yield has to readjust, or that foreigners will pull out their sort of holdings or sort of start selling their US holdings? So the thing is here that the implications for the broader US stock market, but specifically US treasuries and potentially also something like the US dollar, is quite significant. Now, let me emphasize, this is not yet law. This is something which is going through the Congress. It's been passed by the lower house, by the House of Representatives. It still has to be voted upon and probably will be amended by the Senate. So we're not law at this point. But this is something which a lot of market commentators, I was reading some some stuff in the last 24 hours from Goldman Sachs, for example, and they're basically saying they think this is a lot more important potentially than tariffs because the implications of this are huge. As I say, you've got $31 trillion worth of foreign-owned U.S. assets. If those foreign owners start to get a bit spooked and say, "Hey, we now have to, sort of have some kind of capital control, some kind of taxation," this is definitely going to have implications, and also in a broader sort of political sense. This is the first time we're really starting to see sort of what we could maybe call the weaponization of capital control. So Trump has tried to do that obviously with tariffs, but it seems as though his administration now is looking at sort of capital flows and capital controls and using taxation and also wielding this stick against other countries to basically say, hey, you want to tax Amazon or our sort of global sort of corporations by imposing internet taxes or sort of, as I say, a minimum global corporate tax rate. The US is basically saying we will retaliate on your investments in the US and tax you. So things are getting quite nasty and also quite interesting. Okay, guys, I'm going to leave it there. Let's keep an eye on the core PCE at 8:30, which is coming up, and also on the Canadian data for the GDP, see what's going on there. The only other final thing I just want to quickly add, which I forgot to mention, is we have the OPEC meeting coming on the weekend, actually on Saturday. Let's see what the ministers have to say. There's been a lot of chatter that they may increase the output by about 411,000 barrels, which is the number they increased the output last time. And Kazakhstan yesterday was out basically saying that there would be some kind of increases. I think the market at this point could probably absorb a 400,000 barrel increase just because it's sort of expected. But I think anything higher than 400,000, let's say up towards 1 million barrels, would definitely get the market's attention and could be a negative for crude oil. Secondly, last night we did have the Tokyo area, the greater Tokyo area CPI, which was higher than expected. So that at the net's going to be a positive for the Japanese yen because the chances of the Bank of Japan hiking interest rates at their July meeting have probably gone up incrementally because it does seem as though inflation in Japan is a sticky problem. So sort of medium term for anyone sort of interested in the Japanese yen, that could be a positive. Okay, I'll leave it there. Have a great day and a wonderful weekend, and we'll keep on talking. Thank you.